Welcome to the STARS program, seniors taking active roles in society. And now, here's your host, Anita Finley.
Well, this is going to be something you want to get a pencil and paper for, because when you hear Rob Colson, you know he's going to give you a lot of information. I came into the studio today and I said, I just paid on my life insurance a nice sum, and I didn't realize that I'd have to do that. And so Ron said, yeah, and you're going to have to do that next year too. And I said, no way. And I said, and then the wonderful manager of the studio said, well, I don't have to because I have a whole policy. Well, Rob, you told me I don't have one. I have a universal policy. So what's the difference?
Thanks.
Sorry,
Thanks for having me, Anita,
here.
again. That's a good question. People are very confused across the board on really what they own today, and I'm sitting here in front of one of them right now, Anita. And it's really because people go in to purchase stuff from an insurance agent one time, and unfortunately, that may be the last time they ever talk to that person. So what's the difference? There's a huge difference. Whole life policies are a completely different animal than a universal life, a variable life policy, and of course a term policy. The universal life policies are interest rate sensitive, which means they grow in good markets with high interest rates, and they're stagnant and not. And why would I bring that fact up today is because if you're one of those people who reads the Wall Street Journal, the New York Times, or any one of the major newspapers circulating today, over the last 3 months to 4 months, every week or so, they come up with an article on the implosion of the universal life policies. What's happened is, as you've known, we're at a very low interest rate environment right now. So where the insurance companies were able to invest some of those premium dollars you gave them for your policy, they were actually able to make 4 or 5, 6, 7% on that money on various investments, a majority of which are correlated to the stock market and the bond markets. Well, as we've known, and unfortunately the start to our new year here in 2016 has brought nothing but down markets. The S&P 500 was flat to down last year, and over 2 to 3 years, the market has essentially turned sideways. So what's happened is these universal life programs or policies that are interest rate reflection and sensitive, they are underfunded. So the premium that may have been proposed to you, to many, many hundreds of thousands of people across the country, are now getting notices, and the insurance companies have actually delayed now till March, because Transamerica and AXA actually sent out letters to over 400,000 people right around Christmas time.
Yeah, that's my company.
Yeah, letting everybody know that they're going to have a rate increase. Well, they got such strong pushback from the lobbying groups, et cetera, claiming that this was undue process. So the insurance companies have actually halted this until March of 2016. Now, those rate increases are still coming. They're just delaying it a couple more months to, I guess, let people get their premium dollars together, because a lot of people, frankly, can't afford it anymore. What type of rate increases are people seeing? Unbelievable rate increases, from anywhere from 20, 30% to up to 200% increases on their premiums. So what happens is those interest rate sensitive policies, especially universal life and variable life, really are predicated and their performance is predicated on the performance of the stock markets and the overall interest rate environment. So the very big major difference in a whole life versus the universal life is the whole life policy is designed to accumulate cash value to age 100. So those premiums stay flat throughout the whole program. Therefore, you can predict how much your costs are going to be going forward. There is a type of a universal life product. Many people don't sell it because it is a little bit more expensive, which is called Guaranteed Universal Life, which is a GUL. And that program does fix the rates. But many advisors today don't support that program because what they're really trying to do is always get the best deal on the street for their customer. So if a person or client calls up and says, I need $1 million worth of coverage, the average insurance agent's going to immediately run out and try and find the cheapest program in the market. Why? Because he thinks that's the one or she thinks that's one that's going to gain that client's trust and eventually their business. When in actuality, that's the exact opposite way you should be approaching it. So again, we've talked about it on previous shows. There's a lot of different programs. There's a lot of different policies. And depending on somebody's age, their financial situation, and more importantly, how they expect that financial situation to look going forward in the entirety of what they may have that policy.
So I know we have talked about it. So someone, of course, in their 70s, as I am, would be, I can't go out and get another policy now, but there are people maybe who are listening who you can help to get another policy. Would you just drop the other policy? What would you do?
Well, that is a case-by-case basis. What you need to do is have it evaluated. A person like my office can look at this stuff. We very well might be able to replace that coverage. You're still in a relatively good, healthy state. Many times we can replace those policies. That's not our first choice. We always want to look at those policies. Maybe we can do some changes to them. But what a lot of people out there today don't realize is the availability of different product that there is. And a lot of people out there today have diabetes type 1 or 2, and they automatically think, well, heck, I could never get a life insurance policy, or I could never qualify for any long-term care policy. And what we're finding today is it's absolutely not true. I can go through some specific examples and give you some specific examples of what's going on. There are products out there now called what's hybrid insurance. Hybrid insurance allows you to access the death benefit of a life insurance policy in the event that you're unable to perform 2 of the 6 activities of daily living: dressing yourself, bathing yourself, feeding yourself. So if you're unable to perform 2 of the 6 daily activities of daily living, what these insurance policies allow the client to do is access cash from that life insurance policy. And let me give you some cases and some studies, and these are actual cases we've placed. Here's a female who is age 60. She has rheumatoid arthritis. Most people immediately would say, well, that's an immediate decline. Anywhere across the board, you're never going to get that woman insurance. Well, she has immediate needs. She was looking for long-term care. And immediately right out of the gates, her family assumed there's no way we can get her qualified for any of these programs. So through some due diligence, we found some carriers with hybrid products, and we shopped them all. And what happened was that woman was declined for a standalone long-term policy because of the rheumatoid arthritis. Nobody wants to take on that risk, and even if it was, it would be completely unaffordable. We were able to qualify that woman with a life insurance policy with full long-term care benefits. And what type of long-term care benefits? Up to $10,000 a month.
Amazing.
And those are in chronic illness or long-term care benefits. But most importantly, that money is paid directly to the client. So now this is a lady who is 60 years old. She has significant assets, but she doesn't want to deplete them for her family by being in an $8,000 a month convalescent home for the rest of her life. So what's the solution? A, she was declined long-term care, and that's across the board. 2, the life insurance companies will and did approve her on these policies, and now she can access, if she needed it, and she couldn't perform 2 of those 6 activities, up to $10,000 per month out of that policy.
Now, why is that beneficial for that life insurance policy?
It's beneficial because they're using the death benefit as collateral on the whole situation.
Oh, so it just lowers the death benefit, which she doesn't care. She wants money now to be able to take care of her.
That's exactly correct. So it's a situation where she was unable to even get approved for a regular standalone long-term care policy. You know, you have one yourself. They're many times today, they're not only hard to place, but they're incredibly expensive. And the cost of insurance increases have almost been incredibly difficult or impossible for them to keep up with. As a matter of fact, a lot of the ones that probably placed business when you bought yours aren't even in the market anymore.
I know, mine's in rehab. They keep taking care of us, but you're right. They really undercharge what they had no idea. I saw it. I said, how are they going to be able to do that?
Yeah, so you're the perfect example. They're no longer even willing to sell that product to take that risk because they know that the balance sheets aren't adding up. What you're going to pay in and what their potential payout doesn't add up for them. So, again, back to this hybrid product. Now we've found a woman who's been declined, comes to us and says, there's no way I can get anything done. Well, we help manage that estate for them, place the insurance on the mother, and now, God forbid, she does go into a facility. they can access that without draining the rest of the assets.
Absolutely incredible. So do you have a lot of hybrid policies like this?
We're writing, that's probably the majority of what we're writing right now because of that, the long-term care riders.
That is a great news. I'm so glad you've come on the radio to share all this because there are probably more people in that condition than not.
That's correct. And I'll give you another recent example. Here's another one that 99% of the people listening today will say, impossible, can't be done, but it was done. So here's an example of a male, 57 years old, type 1 diabetes on an insulin pump. Now, most insurance people, investment people out there today will go, that's done. He's done. That guy is unwritable. Forget it. Don't even try. Actually, that individual was approved for a policy, a 25-year policy, which allows him to accelerate or borrow against that death benefit up to 24% of his face of the death benefit. In this case, it was a $2.5 million life insurance policy. So what does it let him do? This guy with type 1 diabetes, already on an insulin pump, that life insurance policy will allow him to access up to $500,000 worth of long-term care benefits paid directly to him.
So, that being said, will he still then, let's say he uses it up, will he still then have the balance in life insurance?
Absolutely. Absolutely.
Well, that's really miraculous. Why isn't this more well known?
It's really not, the insurance companies aren't in the business of advertising these products. They look to their advisors to do it. And there are a lot of them doing it today for the simple reason that we are now able to approve people that weren't approved before. So 5 years ago, we couldn't do this with anybody. We would simply have to tell that guy, unfortunately, you should have come to us prior to you being diagnosed with diabetes type 1, prior to having an insulin pump. Because the liability for any insurance company now is incredible. They don't want to take that on. But they will, given the context of these new policies. Because one thing they know for sure is we are all going to die. So they know that the collateral assignment on that policy is obviously back to them based on the money you borrowed from it. So if you're getting $500,000 out of a $2.5 million policy, should you pass away, you still get $2 million, your estate.
I think that is just the best news. And I haven't heard about this, read, of course, from you. You've been sharing that with me, but that really makes the difference. So let's say people have policies, as you've just said, and they have problems. They should call you. And let me give everyone your phone number, and then you'd be able to very quickly figure out if it's possible. So you're going to be calling U.S. Insurance Auditors, and that's Rob Colson, who is the owner. It's U.S. Insurance Auditors, and they are located here in South Florida, and you can actually call them at 954-597-6430. I'll give you that again, 954-597-6430. If you prefer, you can go online and go to usinsuranceauditors.com. So that's, I think what you do a lot of is evaluating, don't you?
It is, because that's the majority of people that come to our office, answer our ads, listen to us on the radio, give us a call. They need help. They're calling us for one reason, because they do not understand exactly what they own. They're not sure about what they're reading in the papers. They know that they've bought this policy of some sort a year, 2, 5, 10 down the road. And they really want some assurance that they're not going to be one of the statistics that they're reading in the paper when they pick it up. Or they don't want to be blindsided when they get to open their mailbox and they see that their premiums went from $3,000 a year to $12,000 a year. So that is what we do. We're in the business of evaluating.
Well, anybody like that, they're just going to drop their insurance. And so the insurance companies are all going to make out a lot of money.
And that's why the delay in the increase on the premium side has been pulled out to March, because there was such an uprising of constituents telling their various senators, you got to go back and oppose these rate increases across the board, and that's what they did. So that's what halted all this for now, 3 months. So
yeah, they never told me. They kept sending me letters. On January the 15th, if you don't pay this, you're going to lose your policy. So I just went ahead and paid it.
Yep. And that's unfortunate. People who can afford to can do it. There's a lot of people that can't. So again, there's a lot of different avenues we can go down, but that is the evaluating process. Because at the end of the day, our job is to figure out how can we best help you keep what you started a long time ago. That's really what the job is.
Yeah, because the intentions were good on all parts. Probably insurance companies said, great, we have a new, client, and the people taking out the policy, they said, gee, now I have a life insurance to protect my family.
That's right.
But they didn't know about the little lines in between, the nitty gritty. And see, if someone had told me to buy a whole life insurance policy and explain the differences, I'm not a gambler, and I probably would have done that rather than take a universal. I didn't really understand it. Like most people, we don't understand it.
Exactly. Because what happens is when the initial policy is printed, they project out based on that point in time how much it would take to carry that policy through maturity. Well, guess what? The interest rates are half of what they were when that story was written. So it's like your bank. If you go to the bank, of course, so for 20 years ago, you could walk in and get a 15% CD. What do you go in there now and get? You're lucky to squeeze out a few points over 5, 6, 7-year lock-ins. There's just not the equity out there for those type of policies or the investments for these insurance companies.
Okay, so what other kind of unique, or I guess we call hybrid, what other kind of policies would there be?
Well, I'll give you another case here, real case. This is a 67-year-old female, relatively healthy, needing some long-term care benefits. Obviously, she's in a position she cannot afford to go out and buy a long-term care policy today for the cost alone, but she needed some life insurance, and she was definitely hoping to be able to get some type of long-term care coverage. So in that scenario, we were able to get her approved on a $250,000 policy with long-term care benefits at a cost of less than $6,000 a year.
That's great. Absolutely great. Now, so she's buying the policy with the long-term care benefits.
That's exactly correct. And what's more important is on this policy with this carrier, the underwriting was based on her mortality, which means they're not going under normal tables. They're going under the general mortality tables, which makes that policy cheaper. Also, more importantly, is all premiums are waived on these policies if people ever go on claim. So what does that mean? Well, that means real simple. God forbid you have this policy, you have a stroke. You now can't perform 2 out of the 6 daily activities. You need help taking a shower. You need help feeding yourself. You need help dressing yourself, bathing yourself. Any of the 6 faculties, or a physician letter saying your cognitive skills are diminished. Okay, once that happens, the claim or the premium is now waived because you have a claim on this policy. So now you're going to incur these benefits without having to pay the premium anymore.
Yeah, that's I want to go back to something though. So you're saying that $6,000 that would have been about $500 a month. She can't go and buy a long-term health care policy for $500 a month?
Not today, she couldn't, no.
Is that right?
No, not at all.
What does for, let's say, because I know you don't have your figures in front of you, but you're very smart and you have it in your head. So a person who's in their 60s, as this woman is, she wants to buy a long-term health care policy. What is she looking at?
Oh, today she'd be lucky to get something in the $10,000 to $15,000 a year range.
Come on.
Her at 67, absolutely.
With no problems at this point.
Absolutely.
I can't even. Wait a second. Did you say, and that's a year?
Absolutely.
So she has to pay $15,000 a year, and then she could have a policy which probably doesn't give that much either.
Probably looking at less than $5,000 a month coming out the back end of that.
So are people buying long-term health care policies?
They're not the rate they were before, and not very many companies even are out there trying to sell it anymore.
It seems to me that buying a life insurance policy, the one that you described, is much better.
It is, especially if you have the wherewithal to purchase a policy of over $2, $3, $4 million. Because remember, you can attach or take out approximately a quarter of that death benefit, right? So if you can take a quarter of a $2 million policy, we'll give you $500,000 worth of long-term care benefit. Well, you know what the cost of long-term care is today. It can run you anywhere from on a low-end facility of $4,000 up to $8,000 to $10,000 at these nice facilities in Boca Raton, Florida.
So if you wanted to buy a $3 million life insurance policy, what is that going to cost you?
Depending on your age. Let's say it's a 65-year-old male again. 65-year-old male putting into a $3 million policy, that type would probably cost him right around $40,000-$50,000 a year.
And that's really only it's only, I was going to say $5,000, $6,000. $6,000 a month. And they would be able to get long-term health care and an insurance policy.
Absolutely. So the asset base was two. Once they're getting $500,000 worth of long-term care benefits and basically $2.5 million worth of tax-free death benefit if that $500,000 was used for long-term care. If you never needed the long-term care, obviously their family estate would get $3 million tax-free. So when you're sitting here, people listening are probably like, oh, my God, that's a lot of money, $40,000, $50,000 a year. But it's not one if you have the assets and means to do it, because look at what the time value of money is. The guy we use as example, 65. Even if he lives 25 years, he would have put less than $1 million into a policy. And what does an estate get? $3 million tax-free. So it comes back to the internal rate of return on insurance is still going to be better than probably any investment out there.
Yeah, I do believe in insurance. I think everything you're listening to now makes a lot of sense. Why don't you give Rob a call? You may have a different situation, but he's pretty smart. He can probably figure out something. I'm sure when you talk to him, it'll get better than it is now. So, phone number for him. Let's give you the 800 number also. 800-218-5033. 1-800-218-5033. Or you can go to his website, which is usinsuranceauditors.com. usinsuranceauditors.com. I'm sitting here with my mouth open because insurance, I remember long-term health care insurance, and I just begged all our listeners for years. I told people they ought to be buying something like that. And at that point, care was like $2,000 a month probably, maybe $3,000. And no one was going to go to nursing home. No one was going to need the care, the home care, nothing. And now, of course, as you said, any decent place is close to $6,000 to $8,000 a month.
At least.
That's right. In fact, we used to hear about places, these fancy places up north and all, but that's what it's taking. So people who bought those small policies, they're going to have to add a lot of money.
No question, because as you know, a lot of the long-term care policies are sold had a fixed benefit. You probably know what yours is, monthly, right?
Yeah, and I'm going to have to pay, a lot more to get help.
I mean, I know from experience. I have family members in the business. The cheapest facilities in our zip codes, Dade, Palm Beach, and Broward County, the minimum you're looking at is $3,000 to $4,000. The nicer facilities, St. Andrews Estates, all of these other ACTS communities, you're looking at $6,000 to $8,000 a month. So you know what a lot of the policies had. They had inflation riders on there, and they were supposed to keep up with the cost of the offset.
Well, mine has one, but it's never going to.
But at least you have something in place, because the facts are real simple. 3 out of 4 of us are going to be in one of those facilities before we die. It's 75%. Well, 22% of people have long-term care benefits. So that leaves 50% of the very population that
with
could possibly with nothing. Exactly. Now, a lot of people are under the assumption that, my kids will take care of me. I'm not worried about it. I'll just go have a stroke. Well, that's not reality. The reality of it is with these new products, we can hit 2 birds with 1 stone. We can provide estate tax planning. We can provide growth in those accounts. We can provide long-term care riders if, God forbid, something does happen to you. So the need to have 2 policies today it no longer exists.
You said something very important, Rob. So even if people don't think about themselves, they ought to think about their family. They really ought to think what it could do to the family. They're not going to let you sit at home by yourself. They're either going to ask you to come into their house, which is going to be interesting for all families, and then you still have to have someone there taking care of you. And so it's going to be very hard on everybody. Wouldn't it be nice just to call Rob, say, look, this is who I am, this is how much money I have, what can I get? And even if you get a policy that they've never had, let's say they don't have a policy, maybe it won't give them a lot of money, but maybe give them something.
Again, what we really need to look at, Anita, is there's the 3 examples I used today are people who impossible to buy them a long-term care policy. Diabetes, age restrictions, and all these things that are prohibitive to somebody to walk into my office and say, look, we have the money. I don't care how much it costs. Get my mother a long-term care policy. I would love to. I would love to be able to take that customer and say, no problem. Here's the ticket. This is how much it is. The fact of the matter is we can't get those people approved on just a straight policy like that. What I'm trying to enforce and make my point today to everyone listening is, if you have any of the things we've talked about, pre-disclosed, pre-existing conditions, where you're sitting at home, you're diabetic, you had some type of heart issues, a melanoma, all these things that people in the back of their mind say it's impossible. No one's going to write this policy for me. The fact of the matter is they are, and we're placing this business. So you do need to have somebody evaluate it. And if you think there's even a possibility of that, and you have the interest, do absolutely give us a call.
Rob, aren't there also people who have 2 and 3 insurance policies? They used to buy them, Tell me about that. What do you do with those? Are they combined or what happens?
No, it's a lot of people like spreading their risk in their minds. Just like banks. People with a lot of assets don't keep their money at one bank. Absolutely not. They would never do that. So they spread it out over all these different banks. Because, again, certain people still believe that the world might disappear tomorrow. So they want to have X amount of FDIC insurance and all their money. So they'll spread that money out all over the banks. Even though a life insurance policy has never not paid a death benefit in the country today, you still have the soothsayers out there to say it might happen to me. So instead of giving all my business to John Hancock, why don't I get a little bit here and a little bit there? That's why they have them all.
Right, I know that. Well, Rob, as usual, you really made me just a little bit smarter, and I'm sure you made a lot of people smarter, and I know that they will certainly call you. And it's a free consultation. You should be so lucky to meet him, and he's a great guy, and you would just love this conversation personally in his office. Thanks, Rob, so much.
Thank you for having me again, Anita.